Did your pension help buy your home? How does this work and what happens in retirement? In Switzerland, using pension money to buy a property is actually quite popular. The scheme has different names. It's called WEF in the Swiss German parts and EPL in the Swiss French parts. To understand this in detail and for you to work out your best option, we're going to follow a family from when they bought their first house to retirement. Hi, I'm Janet. I'm a business finance specialist. I've been deep diving retirement now for over 5 years, and I now make easy to understand content so that you can have a better retirement. Let's dive in. Now, this family has a child, and they've both been working and putting money into a pension pot, and it's been increasing nicely, but they really want to buy a house, and so started saving money in a house pot. A bank mortgage has been agreed, and they've seen the house that they really like. To buy it, they can't borrow any more money, so they've decided to use money from their pension under the WEF scheme. Now, this means that the pension pot is reduced as the money is moved to buy the house. Now, this decision to use your pension money to fund your house purchase should not be done lightly. Here are some of the rules that you should know. Now, first of all, it must be your main home. Now, that means that you're not allowed to use it for rentals or for a holiday home. And that also means that if you suddenly get a job abroad, you cannot rent out your house. You can't start a business from this address. And the money has to be used for improvement, not fixes. So, for example, if the heating breaks, you do have to pay for that yourself from savings and not use any pension money. If you are married, both parties must agree and sign the documents. And finally, if you sell it, you cannot keep the pension money. It must be paid back into the pension pot. So now let's move on with the story of the family. They now have 2 children and need a larger house. Over the years, as they've worked, their company pension pot has increased just a little bit. The value of their house has also increased. Lucky for them. So they decide to sell their house, and therefore they must return the money from the house pot to the pension pot at the sale. On finding a larger house, they once again apply and use the money from the pension pot. It cannot be transferred from the previous house. Now let's understand the rules for withdrawing this money. Number 1, first of all, you have to pay tax on the money that you take out from the pension. For example, if you live in Zurich 8001, it's around 11%, and it's called Standard Pension Withdrawal Tax. Number 2, if you repay or sell the house within normally the next 3 to 5 years, you can claim back this tax. However, if you miss the deadline, which is set by each canton, or as usually happens, you actually keep the house for longer, then there is no tax refund. And by using the pension this way, there are no monthly payments as there are for your bank mortgage. This is, of course, the benefit of using your pension. However, if you sell the house, you must pay back the original value of the money borrowed back into the pension fund. So, as an example, if you borrowed 300, you paid 11% tax, i.e. 33. And that means you've only received 267 due to the tax paid. Now, the pension company deducts the tax before you receive the money. When you sell the house, you have to pay back 300, not the 267. That means you need to take 33 out of your savings in order to pay back the 300. And remember, the money cannot be transferred to another house. You have to apply again and once again pay the withdrawal tax. Now let's fast forward the family quite a few years. The children have grown up and moved out, and the couple are considering retirement. They still live in the same house. The pension pot has grown a little bit as they've continued to work, and the house pot has roughly stayed the same. Now, before they decide what they want to do with the pension and the house, they need to decide how much cash they need for daily living. Now, if they don't need much, or they have other sources of income, they can keep their house. But their pension annuity, that's their monthly pension that they will receive, will be very small. If they decide they need more monthly cash, and they would feel better with a full pension annuity to pay all their bills, then they would need to sell the house before retirement and pay all the money back into the pension. That means at retirement, they would receive the full monthly annuity. And for some people, this is really important. It gives them added security. The mortgage is, of course, repaid, and they would now need to either rent, or they can use some of their savings, if it's enough, maybe to buy a small place, but without using future pension funds. So what happens if the couple prefer to take the cash out because they want to invest the money in the market and earn income that way? Well, here's the most tax efficient way for them to do it. Number one, they should keep the house. They should then retire, and then they should sell their home. This means the money never goes back into the pension pot, and they can put the money directly into a broker scheme, avoiding having to pay double pension withdrawal tax. Now, this is a very important point. So if you're not sure about this, just listen again. Now, for those who find it easier to understand by looking at numbers, I've created a quick example. Here goes. So in our example, the pension pot's in gold and the house pot is all in pink. Now, I've looked at several points over the years, from before first house, after selling the first house, the second house, and finally selling before retirement. So let's have a look at the data. They've both been working and putting as much as they can into their pension pot. They haven't yet got a house, so the house WEF and the mortgage are irrelevant, but they've been saving hard for a house. They then buy their first house and they use their pension pot, which means that they take 300 out of their pension. The pension company takes away the tax, which is based on the canton and the amount taken, and so they're left with a net of 267 that goes into their house. They have a mortgage and the savings stay the same. Now, they stay in that house for 10 years, which means that they cannot claim back the 11% tax. And they decide to sell because they decide they need a second home. So the 300, not the 267, the 300 has to be paid back to the pension pot. The house WEF and the mortgage disappear, and the savings is down by 33, which means that in order to pay back the 300 to the pension pot, they have to use 33 from their own savings account. They then find their second house, and they need to borrow money from the pension pot again. Once again, they take 300, so they're left with 200. And once again, they are taxed, so they only get a net of 267. They get their mortgage a bit more now because the house is a little larger, and they use their savings, which is now reduced, of course, to 67. They've now decided that they would like the full pension income, i.e. the full annuity when they retire. So they've decided to sell their house and repay their pension fund. So they've repaid the 300 on selling of the house. The house WEF, of course, returns to zero. The mortgage is zero. And now they have only 26 in their savings account because they've had to use 33 to add to the pension to pay back into the pension pot. Now have a look at that again if that's unclear. So what does that mean? This means that they now get the full monthly pension because they've paid all their pension back into the pension pot. If they decided to take that 500 or even part of it out as a cash withdrawal, they would have to pay another 11% cash withdrawal tax, which means that they would actually only be able to get 445. And don't forget, they are also left with a lot less savings. Let's have a look at what happens if they sell their house after retirement. They would only have the 200 because that's what they have in the house. They only have 200 in their pension pot, and that was fixed on retirement. That has not changed. The 267 that used to be the house WEF is now theirs. That's their money, has been taxed, and is no longer part of the WEF program. The mortgage has been repaid on sale of the house, and they have 67 in savings. Their savings are also higher because they didn't have to pay back the full pension amount on selling the house before retirement. So what does this mean? They have a smaller annuity, i.e. a smaller monthly pension payout. The 267 is now theirs. They've already paid tax on it, so this is theirs cash in hand. They can also use this for investment, and their savings have been preserved. So what are the takeaways? Well, firstly, pension money is really useful when buying a property, but it's not free. You do pay pension withdrawal tax, and the rate depends on your canton and how much you're withdrawing, and you have to compare that to the low interest rates that you can presently get for a mortgage. Now, tax refunds may be possible if you meet the deadlines, which can be very short. However, most people keep their houses for a lot longer. If you sell your house and buy another one, you can't transfer the pension from one to another. You have to return the original amount to the pot, apply and withdraw it again for the second property. And once again, you'll end up paying pension withdrawal tax. And remember the restricted use. You can never rent out the property, even if you move abroad or you decide you wish to live somewhere else. Now, the second takeaway is before retirement, work out how much cash you really need. If you were really keen on having a max annuity, i.e. pension income per month, then yes, sell your property to fully refund your pension. Now, if you have enough savings, you can also use that instead. Now, if you're not keen on having a full annuity and will prefer to keep most of it in cash so that you can invest it yourself on the stock market, then sell the property after you retire. And if you're lucky and the present smaller pension is enough for you, then you can just keep everything as it is and stay in your beautiful home. If you have any questions, let me know in the comments. If you like this video and you would like to see more, please give it a thumbs up and don't forget to subscribe.